When we look at gold, it still has this very strong chart pattern, this trend to the upside, and it could very easily regain its traction. And our upside target is potentially 51 to 52. And if we were to look at the, let me just pull up the chart here. This is the monthly chart of gold. This red box here is what I'm in a perfect world, we see gold and silver and everything just shoot higher, just go absolutely ballistic for the next 1 or 2, maybe even 3 monthly bars. This is the monthly chart of gold. And then we see it have a big correction and come back. Very similar to... We are anticipating January to start out with a little bit of a rally just based on seasonality wise, but we do have some of our technicals showing that's kind of what we should be expecting. Now, when we look at our 30-minute chart of the S&P 500 futures, we can see we have in the past, we get into a little bout of panic selling, which is this green indicator that comes up to this blue line. You can see once you get in there, you generally find the market put in a pivot low, and then it goes into a bounce or a rally. Now, we've seen the same with the previous session. We got up here, we got into panic selling, and then we saw a little bit of selling and people unloading positions into the end of the year, the final hour, and that pushed the panic selling indicator up as people just rebalance and kind of want to start the year fresh. And today, of course, we're seeing the markets have a bit of a bounce. We're seeing the NASDAQ up nearly 1%, the S&P 500 up 0.5%, the Dow, the Russell, everything is moving up in terms of equities. So we'll see how this plays out. I'm not a fan of gaps to the upside because typically gaps get filled. But when we look at our daily chart and we just kind of zoom into where the price action could go over the next couple of weeks, we do have a few different Fibonacci levels where price could go. So we have the first one, which is here, and this pullback, and it is telling us that we could go up to 71.46, which based on that small pattern here is about a 3% move to the upside. Now, if we take a look at the bigger Fibonacci pattern, we've got a bigger move up here from the November lows, and then we had a pullback, and then we went into this bounce phase, and that is saying we should bounce potentially all the way up to 72.25, which is about a 4 1/3% upside move. So we'll have to see how all of this unfolds. When we step back and just look at the chart pattern, we obviously have, this is pretty big volatility. We've got a lot of sideways chop. It's kind of a noisy chart pattern. But the shorter term price action still is a series of higher lows, a series of higher highs. And this here is a bull flag pattern, which points to hopefully another move over the next 5 to 10 trading days. And the question is, how high can it go? Now, if we take a look over at the NASDAQ, it's somewhat similar. We're not threatening all-time highs here. Let's just zoom in a little bit. It is trying to get back up to get to all-time highs, but obviously the Magnificent Seven have been under some pressure, not really participating as much, and we're starting to see a nice bounce here, and it is pointing to higher pricing. Now, if we do use the same analysis, we can see the max upside for this next measured move is roughly...
Zooming out from intraday noise reveals a market still carving higher highs and higher lows. Despite choppy conditions, broader price structures resemble continuation patterns rather than breakdowns. Fibonacci projections point to multiple upside targets over the coming weeks, suggesting gains in the low single-digit range are technically achievable. These moves may unfold gradually, punctuated by pauses and pullbacks. Importantly, trend-following strategies thrive in these environments by letting price action, not emotion, dictate decisions. While volatility may cloud clarity in the short term, the underlying structure continues to favor patience over prediction.
From where it is set to open from previous session, not including this morning's bounce, is about a 6% move from there. From the open this morning, based on the price action, it's about a 5% move. So there's still some good upside that would push us to some all-time highs. And of course, if we look at seasonality, the seasonality chart shows for January, we tend to see the market have a pop and rally for the first week or so. And then it gets into pretty big volatility and chops things up. So we'll just have to let this market unfold. We're on side with the current positions. We're long the markets. The trends are up. And we just have to let the underlying trend and let the market do all the work while we just kind of ride the trend. Now, if we take a look at the seasonality chart of gold, again, we don't trade based on seasonality. We just like to know if we have a tailwind or a headwind behind our movements. Now, overall, the trend is still strongly up for gold, silver, platinum, and palladium. Gold and silver, to me, have the stronger chart patterns of them all. And it does show that we could see a little bit of a weakness here first week of January. Maybe money flows into stocks and out of gold. And then we start to see another push higher in precious metals. But you'll notice precious metals pretty much fall out of favor into July, August. And we are in this last potential pop and squeeze for gold, meaning we should see it pop and rally as everyone piles in and chases it higher and repositions for the year of new taxes. And they get back into precious metals and we see that big move. So as most of you probably know, I believe we're in this stage 3 where sectors are all over the place. It's not a huge broad market rally. It really is very selective, and whatever sector is hot 1 week or 1 month, it's out of favor, and it becomes from the best asset to the worst asset, back and forth. And that is the sign of a stage 3. That's sector rotation. Money doesn't really stick anywhere. It just moves in, tries to catch an opportunity, and then rotates out. And during the stage 3, is also the time when we start to realize that we're in a stock market cycle where precious metals, energy, industrial capital goods, people are bullish in all of these phases and they come to life and they do well. And that's exactly what we've been seeing.
Technology shares, particularly large cap leaders, have lagged recently, but signs of stabilization are emerging. Broader tech indices are attempting to regain upward momentum, supported by historical January seasonality. While participation has been uneven, measured upside targets still point toward potential retests of record levels. Seasonal data suggests early year strength often gives way to mid-quarter turbulence, reinforcing the importance of managing expectations. Rather than chasing headlines, disciplined investors focus on structure, trend direction, and risk management. If momentum holds, technology may once again reassert leadership, but not without resistance along the way.
And it's also usually the end of the market. The stock market top is nearing. So that is kind of what we need to be aware of when we look at that Benner cycle that we've talked about a few times in the past. This is from the 1875. These are based on the cycles. And of course, not all of them have happened. They don't always happen exactly on the year. But you can see when you have 2 cycles topping in 1999, that was when we hit a major panic level. And we saw the tech bubble. In 2007, we had a one significant cycle top out. That was the financial crisis. 2019, we had COVID. And then the next cycle here is really 2026, which is this year, expecting the markets to top out. And this is something I've been talking about for the last year and a half, maybe even 2 years, that the signs are there that we're getting closer and closer to a major economic top. And of course, these massive economic cycles don't turn on a dime. You have to wait for all of momentum from businesses and stocks and all of them, the sentiment of all the investors to slowly change direction and for the tide to go from going up to start to come down. And we are in what I believe is the last few months potentially of the stock market going up and precious metals. And we're going to probably see a very big decline. And based on this cycle here, it says we're going to be in a very difficult market and economic climate until 2032. So this is going to be a very dramatic 6-year move in the market where you either thrive or you actually struggle. And obviously we want to thrive and not have to go through the headaches of losing a lot of money and worrying about the economy and all of that stuff. So let's dive into the dollar really quick. When we take a look at the US dollar index, it's posting some gains here. It is still trying to carve out a significant bottom. Obviously, we saw a big unwinding event from the tariffs, really doing a lot of damage, I think, to the dollar. It's been trying to put in this bottom, and it's very close to potentially working its way up. If it can start to break through this level here, somewhere through this, there's a couple different thresholds through here, but if it can obviously start to get up to these levels, then we're probably seeing the stock market putting in a major top. Precious metals will probably be peaking as we see gold break either this level or this level. We'll probably see metals peak out, and then we'll probably see the stock market crash as the dollar rallies up to probably this 109. Of course, it could go even higher if we go back in time. There's other thresholds at 114 and 120, way up there, which means we'll potentially see the stock market and the economy going dramatically lower. But right now, the dollar is still working through this base. It can trade sideways and rally in a fairly big range without affecting gold too much. So we don't need to be too worried about gold rallying over the next couple of weeks, the dollar rallying, because I don't think it'll play too much into gold. Gold and precious metals are a very strong play right now, where money is just either piling into it or having some quick days of profit taking or some margin requirement changes that that forces some forced selling going on.
Gold and silver remain in long-term uptrends, even as short-term rotations temporarily redirect capital toward equities. Historically, precious metals experience intermittent pauses early in the year before resuming strength. This pattern often reflects portfolio reshuffling rather than structural weakness. More broadly, markets appear to be entering a late cycle phase marked by aggressive sector rotation. Leadership shifts rapidly between assets, a hallmark of mature bull markets. Energy, industrials, and metals often thrive during this stage, benefiting from inflationary pressures and supply constraints. Such conditions frequently precede major turning points in the broader market cycle.
When we look at gold, it still has this very strong chart pattern, this trend to the upside, and it could very easily regain its traction, and our upside target is potentially 51 to 52. And if we were to look at the, let me just pull up the chart here. This is the monthly chart of gold. This red box here is what I'm in a perfect world, we see gold and silver and everything just shoot higher, just go absolutely ballistic for the next 1 or 2, maybe even 3 monthly bars. This is the monthly chart of gold. And then we see it have a big correction and come back. Very similar to 2007, 2008, where it expands and then has a sharp pullback. And then, of course, it goes into a multi-year rally. And after we see this type of roller coaster ride, however much gold rallies and pulls back, then we're headed up to 7,500 and beyond. But obviously, there's a lot of potential to the upside and a lot of potential to profit or to avoid the pullback, to reload going forward, or an opportunity to get into different plays like miners once we see this pullback. I like physical gold and silver on the way up. After the correction, I'm probably going to be more favored. I will still like physical metals, but I think the miners will be the bigger opportunity percentage-wise. That's when I think they go absolutely ballistic. They've had some very nice runs recently, but I think that's chump change compared to the next cycle, like what we saw after 2007, 2008. We went into a multi-year rally, and the miners rallied not just hundreds, but they rallied thousands of percentage points. And of course, a lot of those miners will get absolutely hammered when gold and the economy and the stock market tank, because it has everything going against it. The miners will have the stock market going down, which means there's natural selling in the stock market. There's gold going down, so its underlying asset they're making less per ounce as gold collapses. And then, of course, the economy is weak and people naturally have to sell and liquidate and margin calls. So it creates an opportunity for the next big move. And that's what happened back over here as well in 2008, 2009. We saw miners just put in a massive bottom and then take off.
Long-term economic cycles suggest markets may be approaching a critical inflection point later this decade. These transitions rarely occur suddenly. They unfold gradually as momentum fades and confidence erodes. The US dollar, meanwhile, is attempting to form a base after a prolonged decline. A sustained dollar recovery could coincide with peaks in both equities and precious metals. However, short-term dollar strength does not automatically derail gold, particularly during periods of geopolitical uncertainty and inflation hedging. Understanding these intermarket relationships is essential, as shifts in one asset class often foreshadow broader systemic change.
So let's take a look at one other asset class that pretty much most of us have, which is real estate. If we look at the IYR real estate ETF, I believe real estate is going to have a very big correction over the next couple of years. Now, it drags out over many years. Real estate is a bit different beast. It doesn't move quickly like the stock market, but you can see what happened last time we saw the financial crisis. Now, this was definitely tied a lot more to mortgages and homes, but the real estate ETF fell about 77%. Which means to get to break even, you have to make about 350% after that. Plus you missed out on, a decade, 15 years of no return. And really from those highs, the real estate ETF is still exactly where it was in 2007. So you're talking like, 19 years or so, a long time of no big returns. You do earn dividends, but you've gone through a roller coaster ride. And there's going to be a huge opportunity when I think the markets reset and real estate falls off a cliff. And of course, it'll be an opportunity to get into real estate through REITs. And I do like REITs when they are oversold and have good value, because you're buying them undervalued. They pay big dividends. And then, of course, not only do you earn big dividends for a very long time with a fairly solid asset, but the price of the shares go up quite dramatically. You can see the value go up 100, 200% plus amazing dividends the whole way up. So that's something we're going to keep our eyes peeled for. And right now, when we do look at the real estate space, it's actually been holding up fairly well over the last year. It's trying to figure out what it wants to do. And a lot of people, when they get nervous, which is what we've been seeing, the gold market moving up means investors are nervous. They tend to move into assets that they know, which is real estate, which is why I think we've seen this pop and this flag sideways. It is pointing to it may want to have another push higher. But again, we're not looking to trade the real estate space until it gets unwound and oversold, and we see the economy actually take a big downward swing. So let's take a look at our band positions really quick for those of you trading the band strategy. Obviously, we had SLV. We hit our target. We got in here. It rallied up, hit our 20% move, and now it has gone into this big volatility stage where it rallies up 10%, drops 10%. It's back and forth. Huge volume, huge volatility. It's pretty ugly, but it is consolidating in a sideways phase. And this chart pattern, when you look at the daily chart, that is hard to read, figure out what's going on, but really it is still holding up. The futures chart of silver shows a little clearer of a picture. Let's go back to the daily chart here. You can see silver is forming still a bullish type formation here that is pointing to higher pricing, but there's a lot of volume, a lot of volatility. A lot of this has to do with margin calls, margin requirements, and just not only that, but it hit our measured move. And then as we know from our measured move marks, once we got in and it hit our measured move of a 20% move based on Fibonacci, it goes into this blow off phase, and then the market has to reset and regroup. We had the exact same thing happen with our GLD or our gold trade. If we just go back over here, we got into GLD on the breakout with our Fibonacci movement. It hit our 100% measured move right here. And then it went into this crazy wild volatility phase, the blow off phase where everybody chases it near the end. And then they go into lots of volatility until it builds a new launch pad and starts to break out. So everything is moving according to plan. We're just, the markets will drag out. They take longer than most of us expect. You can see patterns coming. You can see what's unfolding. And it does feel like it takes forever to happen when you kind of know what's unfolding. But the markets really do take a lot of time for these huge economic and cycles to unfold.
Every major expansion eventually gives way to correction, and history suggests the next reset may create generational opportunities. Equities, real estate, and miners are all vulnerable during downturns, but also offer exceptional value afterward. Precious metals often stabilize first, while mining stocks typically suffer deeper drawdowns before launching powerful recoveries. Real estate, slower by nature, tends to unwind over years rather than months, rewarding patient investors who enter during periods of distress. The lesson is clear: volatility is not the enemy. Preparation, discipline, and long-term vision determine who merely survives and who thrives.